Hi, welcome to our weekly market update for Morton Brown Family Wealth. I'm Dennis Morton here with my partner Cady Brown and Cody Demmel. Katie and Cody, how are you guys doing?
Great.
Good, good.
Happy it's May 1st.
May 1st, May Day. So we are sitting here on the far end of a pretty robust month of April, coming off of the opposite in March. So Cody, why don't you tell us a little bit about where we stand?
Yeah, so year to date, the markets are still down, with the S&P 500 down around 12%. The Dow is down around 17, and the NASDAQ around 4. With that said, we are up a lot from the March lows. March 23rd is when we hit the lows of the year. We're up over 25% since then. So we have had a good bounce back. So we're optimistic about the future, but still want to be cautious.
Yeah, it was interesting that having those 2 months back to back. I think it's the first time in 40 years that we've had a double-digit down month followed by a double-digit up month. It felt a little like that, didn't it, Katie?
Yeah. It's crazy. If you were paying attention, your stomach was churning, but if you weren't paying attention, you might have missed the entire thing.
And I think the heartening thing I think we were talking about was the more normalized pace of things. We weren't getting 5 and 7% moves or 10% moves. We were getting, 1 and 2. It felt a little bit more orderly than it had been.
Mm-hmm. Mm-hmm. And it's interesting too to even look at the 1-year returns because on a 1-year basis, the domestic markets are only down 3%. In bond markets, the U.S. aggregate bond index is up almost 10%. And so that could happen in a normal 12 months. There's definitely a little bit of whiplash that happened over the past couple of months.
Right. When we talk about leadership coming out of this, Cody, where are you seeing kind of some of the strength, to the extent there is strength? Where is it in this market?
Yeah. So far, the tech has definitely been leading the market. Like I just discussed, the NASDAQ's only down around 3% year to date, and the Dow is down around 18. So the tech is definitely leading the market so far.
That could be I think that's one of the strong suits that we have in the domestic economy, especially relative to international, is just how much of the S&P 500 is made up of technology. It's over 20% technology. And if those are some of the names that are carrying the day, if you're an economy that's exposed to energy or other commodities, if you're in banking or finance, that's a big drag on performance right now.
Yeah.
We talked about go ahead, Katie.
I was going to say, and that might help explain part of why the U.S. markets over the past couple of weeks have bounced back much more quickly than international markets. It's all about where the exposure is at and where the returns are being driven from.
Yep.
So we had the economic shutdown, and we're starting to see the ripple effects and repercussions of that. The oil market was one thing last week. We had negative oil prices. Mm-hmm. Now that you're starting to see things on numbers coming back on retail. Katie, you found an article that was great. Tell us a little bit about that.
Yeah, there was just a really interesting article. I think we've known for a little while that some brick and mortar stores have been under fire, under pressure for a while. I mean, last year, Sears went into bankruptcy, Barney's New York went into bankruptcy, and stores that were under pressure are feeling even more of it now. So I came across this article in the Washington Post earlier this week. It was iconic brands that could disappear because of the coronavirus. And it highlighted, it noted in there that 260,000 stores have had to close their doors. And, questioning whether or not 100,000 of those are going to be in existence here by 2025. UBS had done a study that kind of raised that concern. And I think something that was really unique in the article too was highlighting some of these stores that were in stress prior to going into this, and they have been downgraded. The ratings are lower, their financial balance sheets are weak, and so they're not able to access a lot of the stimulus money that's being pumped into other industries and other businesses out there, and so they don't have much to weather this storm. So
Right. And there's always that idea of they call it the velocity of money, how fast money moves through the system. And if you're thinking about retail, yes, there's dollars being put in consumers' pockets, but then it stops there. It's not really, it's shoring up reserves. It's going to staples like food or home expenses, but it's not going to apparel or something like that. It's not going to J. Crew.
Right.
And that's part of the issue.
Right. On a year-over-year basis, apparel's down 51%. So it's in other places are feeling it too. I mean, it's not just clothing. Restaurants, of course, are feeling it too. They're down 24% on a year-over-year basis. Something I did think that was interesting in the article: specialty stores on a year-over-year basis are down 6%, and I think that talks a lot about how the consumers, they're shopping online for the day-to-day stuff, but if they want that special Easter dress for their daughter or that unique gift, they're still going into, they're finding the boutique places, those specialty shops to serve that purpose.
Interesting.
Yep.
Yeah. Cody, what did you see? You were commenting on some of the foot traffic numbers there.
Yeah, so looking over the article that Katie sent over from the Washington Post, it is crazy. I mean, obviously we know that a lot of the stores were shut down, but when you actually see it on a chart and you see, say, for an example, Dennis was just talking about J. Crew. J. Crew's foot traffic is down 97%. Neiman Marcus down 97%. There's JCPenney down 95%. Just seeing those numbers is just really, really crazy to see.
Yeah. So there's, these are large, in this case, large publicly traded companies, so we can see what that does to the stock price and the pressure it puts on there. There's another side of the economy. We talk about where consumers are deciding to spend or not spend, where they're going to invest or not invest. There was an article in the Wall Street Journal yesterday about education, colleges and universities, and the pressures that they're coming onto now, which they think could be existential. So the article cited that even heading into this year, the University of Pennsylvania found that, or projected that of the 1,000 private liberal arts colleges in the United States, 100 of them would not survive the next 5 years. Now they're thinking it might be 200 of them, of that 1,000, that may not survive the next year. And this is because, and they were facing declining enrollment. They were facing pressure on tuition. Some of them with state funding that was shrinking because of budget pressures. So add on to that all of the questions: is there going to be a fall semester? What shape does it take? And suddenly you have these major institutions that are on their heels and not sure if the business model is sustainable even heading into the next academic year.
Right. And you're right. It's a question of whether or not tuition's coming in, whether students are going to return to the fall semester, but also what's going to be there. I mean, what happens to athletics? Because, for some of the larger schools, the revenue that's generated from their, Big Ten football team is a huge piece. Or something I thought was really interesting there too, John Hopkins, and they were talking about the amount of revenue that comes to them from the health system because they have that relationship. So it's, you kind of get the double whammy of it, lower revenue coming in from the student body, but then also from the outside sources as well.
Yeah. Okay, Cody, flash back to a few years ago for you coming out of college, or if you're in college, a gap year. People are talking about it. Do you take a gap year, which is pretty common outside the U.S., not necessarily a term we think about too often here. Would you have considered that at the time, or how would you approach that?
I don't know. Thinking back to if I couldn't enjoy college or do everything the same way that I did, like go to the sporting events, don't have the large auditorium classrooms, hopefully it'll not happen. But if that does happen for the fall semester, I probably would have thought about taking the semester off or doing a semester online. I probably wouldn't have actually taken it off, but doing it maybe more local or online, definitely would have thought about it.
Yeah. And the economic implications, we work with people who are planning for college savings for their children or grandchildren, or, they might be, student debt is certainly a big issue that affects the generations in the 10, 15, even 20 years after coming out of college. But even the small towns, think of all those college towns where that is the economic engine for them, to have the restaurant traffic and the social scene. And if 200 of those college towns are impacted, that's pretty meaningful. Just
Yeah.
change your way of life.
Yeah.
So,
Definitely, you touched on it. You started to touch on it a little bit. It definitely impacts how you might want to plan for college for your children or for your grandchildren. College is one of the largest price tags out there. It's one of the biggest planning items for a lot of families, and they might be, rethinking to what degree do they want to pre-fund that through some type of savings vehicle, or maybe using a different vehicle that isn't as captive to education planning. So I think revisiting goals at this time is a prudent thing to do.
so one other topic that's been tossed around between us over the last few weeks is the one place there is a bull market right now is in expertise. There's experts everywhere. We have experts on the stock market, experts on viruses and public policy and everything else. And one of the observations that just keeps coming to top of mind for me is just how wrong we can all be on the short-term type of decisions. I think, in the world of investing, we're always saying we have to think long-term because in the short term, anything can happen. And we're seeing that in real time with, public policy decisions and medicine, because the information that we have just isn't sufficient enough in the short term. And we're kind of missing the mark a lot on what could happen, should happen, everything else. One person that I think historically has done a really good job of that is Warren Buffett. So this weekend is the Berkshire Hathaway annual meeting, and Buffett has been notoriously silent during this, hasn't said much at all. And I think it's largely because, he doesn't like making decisions based on short-term information. And we want that a lot. Right now we want the experts to tell us what's going to happen, how many infections are there going to be, what's the impact going to be, when are we going to open back up? We want that certainty and that information. We just can't get it. And I'd be interested to see what Buffett, as he speaks this week, and how he's thinking about this crisis, and how he as an expert kind of approaches this framework. I don't know if you guys had any observations of what you've seen from the experts of late.
I think even just bringing up Buffett, though, is a really great example because he is extremely patient. He's always been a patient investor, and it is difficult to carve out room for that patience right now. You're exactly right. People want to know, the medical experts, they want to know every detail of where we're at and where we're going and when it's going to be done and when we're going to have a vaccine. And it's just, some of that stuff, probably rightfully so, falls into the too hard pile.
Yes.
I know you often talk about the too hard pile, which if you want to touch on that, I think that's really interesting with Warren Buffett.
Yeah, so Buffett and his partner Charlie Munger, one of their frameworks for how they think about decision making is if they have enough information that they can make a reasonable decision and invest with a margin of safety, then they're comfortable making that decision, knowing what the risks are. But sometimes they just don't have enough information to make that decision, so they put that decision in the too hard pile. Don't have enough, can't decide on it, so it's too hard, it sits over there. And it kind of relieves you from the burden of trying to overthink something that you don't have enough information about. This whole situation, as much as we need to manage through it, it probably belongs in the too hard pile because we don't have enough information to work with. We have to manage with the data that we have and be prudent, but that's why we wouldn't advise people to make those kind of big investing commitments or big decisions right now, because to do so, you're assuming that maybe a lot more than you actually do. And so I think it'll be interesting to go back and read through some of his comments from the weekend that comes and learn a little bit about what a famous decision maker does during a time of crisis.
Yeah.
So good. All right, guys. This has been a good conversation. Just wanted to share some of the ideas that have been top of mind for us. But we're heading into the weekend, so I'm sure you guys have a little bit queued up on Netflix. Cody, what are you watching recently, or what's queued up for you?
Yeah, so recently, Courtney and I, my fiance, have been watching Ozarks. We are through season 2 now. I think we'll probably watch a couple episodes of season 3 tonight.
Very, very good. Very good. Katie, how about you?
Packing the violence there. Crazy.
It is pretty violent. Yeah.
Yeah. But it's really, we watched through season 3 on that. It's really good.
Full disclosure.
Yeah.
Well, if we're turning off Disney Plus, so once again, I'm assuming this is no kids in the room.
Yes.
So Deke and I, it's funny because we don't historically watch a whole lot of shows, and we haven't watched a whole lot. So the other day we kind of had the epiphany. We're like, you know what? We've heard Breaking Bad is really good. Maybe we should watch that. So we watched, episode 1 of season 1. So don't ruin it for me. We're not that far along.
That's all right. Yeah, we actually decided to step in the Wayback Machine, and we were looking. We've been documentaried out. We had watched all the real life, all the reality we needed. Was that we were fine with that. So we said, let's watch some comfort food, and we pulled up season 1 of Cheers and started watching a few episodes of that, which is pretty incredible. The idea of going someplace where everyone knows your name sounded pretty good at the time. So it's very entertaining. Holds up really, really well.
Good.
All right, guys. Well, we hope everyone has a great weekend. Feel free to reach out to us. You can find us at www.mortonbrownfw.com. We hope everyone has a nice weekend, and we'll catch up with you next week.
Bye. Thank you.